Are you ready to uncover the hidden levers that can dramatically shrink your tax bill? Forget the big, obvious deductions for a minute. Today, we're diving deep into the intricate, often overlooked world of gains and losses on your assets. This isn't just about understanding tax jargon, okay? It's about unlocking direct, actionable strategies to keep more of your hard-earned money and, optimize your financial future. We've compiled a really comprehensive stack of insights here, pulled directly from the tax code's playbook. Our mission is pretty clear: to equip you with the precise knowledge to navigate the disposition of your assets, whether it's stocks, property, or even, say, a cherished collectible, with absolute clarity and confidence. Think of this as your shortcut to making smarter financial choices, especially around tax time.
Indeed. And it's fascinating because many individuals and businesses, they realize a gain or loss on their assets, sure, but the real mystery often lies in how that gain or loss is actually calculated, and even more critically, how it's ultimately taxed. What we consistently find, and this is key, is that seemingly minor distinctions within these rules can lead to significantly different outcomes for your bottom line. So today, we're going to unpack the core mechanics, delve into the critical classifications, and reveal the often surprising rules that govern how your asset sales impact your tax liability. And we'll always keep an eye toward, practical application and potential tax savings for you.
The foundations. What exactly is a gain or loss on disposition?
Okay, let's unpack this from the very beginning then. When we talk about a gain or loss on disposition, for many of us, that just sounds like, well, selling something for more or less than we bought it for. Simple, right? But I know it's almost never that simple with taxes, is it? What does that phrase truly encompass for someone selling maybe a piece of property or some shares in a company?
You've hit on the core misconception right there. It's far more nuanced than just comparing a simple purchase price to a sale price. At its essence, yes, a gain or loss is determined by comparing two main figures: the amount realized from the sale and the adjusted basis of the asset you're giving up. Think of it as a subtraction problem, sure, but one where the components themselves have these crucial definitions that can dramatically alter the final number, and therefore your tax bill. Understanding these two figures, amount realized and adjusted basis, is the absolute foundation of tax-efficient asset disposition. Let's start with the amount realized. Now, this isn't merely the cash you receive when you sell something. It's a much broader concept. It's designed to capture the total economic benefit you gain from the transaction. So this includes any money you receive, obviously, like the direct cash payment. But it critically also includes the cancellation of any debt that the buyer assumes or pays off for you.
Ah, okay, so if they take over my mortgage, that counts.
Exactly. That debt relief, sometimes called boot in exchange scenarios, is a huge component many people overlook. If you sell a property with a mortgage and the buyer takes over that mortgage, the amount of that mortgage relief gets added to your cash received when calculating your amount realized. It's like you received that cash and paid off the debt yourself. Furthermore, if you receive any property in the exchange instead of cash, it's fair market value. The FMV at the time of the transaction is also counted towards your amount realized.
Gotcha. So it could be cash, debt relief, other property.
Precisely. And then finally, from this total sum, you then subtract any selling expenses you incurred. Think of things like real estate commissions, legal fees for drafting sale documents, maybe broker fees on stock sales. These expenses directly reduce your amount realized, which in turn reduces your potential gain. So tracking those is important. It saves you tax.
Okay, that's amount realized. What about the other side of the equation, the adjusted basis? Is that just my original purchase price?
That's the starting point, often. The adjusted basis is essentially your investment in the property for tax purposes. Typically, if you purchase the asset, your basis is simply your original cost. However, this is where the calculation can get much more complex and actually strategically important depending on how you acquired the asset. For example, if you receive the asset as a gift, your basis might be what's called a rollover cost from the person who gifted it to you.
Meaning I inherit their cost basis.
Essentially, yes. You step into their shoes. This can be, well, a blessing or a curse, right? If the asset has appreciated significantly, you might inherit a very low basis, meaning a bigger potential gain for you down the line. There are also some specific rules if the asset had actually decreased in value when gifted. Your basis might be the fair market value at the time of the gift in certain cases, mainly to prevent people from just gifting losses around. But those are quite specific. And here's where it gets particularly interesting and honestly a truly powerful tax planning opportunity: inherited assets. If you inherited the asset, your basis generally steps up or sometimes steps down to the fair market value on the date of the decedent's death.
Step up in basis. I've heard of that. That sounds huge.
It is huge. It's incredibly significant for heirs because it effectively wipes away any capital gains tax liability on the appreciation that occurred during the deceased person's lifetime. Imagine, say, your grandparent bought stock for $100 decades ago. It's worth $10,000 when they pass away. Your basis, as the heir, becomes $10,000. If you then sell it a week later for $10,100, you only pay tax on the $100 gain that accrued while you owned it, not the $9,900 gain that built up before you inherited it.
Wow. So that entire gain just vanishes for tax purposes.
Exactly. For income tax purposes, it vanishes. This step up in basis is one of the most powerful tax benefits available. It offers substantial savings, especially on highly appreciated assets. So for you, the listener, if you're ever inheriting assets, always confirm this basis. Get an appraisal if needed. It's a critical strategic advantage.
Okay, so it's clearly way more than just what I paid versus what I sold it for. It's about the whole picture: debt relief, selling costs, how you got the asset, gift, inheritance, purchase. This sounds like an area where it's easy to overlook key details. Can you give us a concrete example, something from our sources that really shows how these maybe hidden elements can make a big difference in the final gain number?
Absolutely. Let's look at example 1. It perfectly illustrates how that often overlooked debt relief can significantly increase your calculated gain. The facts are pretty straightforward. Imagine a taxpayer owns a commercial property. Their basis, their investment, is $70,000. Now, this property is subject to a $45,000 mortgage. They convey the property, sell it to someone else. They receive $60,000 in cash directly from the buyer. And crucially, the buyer assumes takes over that $45,000 mortgage.
Okay, so $60K cash, $45K mortgage taken over, basis of $70K. How does the gain calculation work?
Right. Remember, the amount realized is the total economic benefit. So it's not just the $60,000 cash, it's that $60,000 cash plus the $45,000 in debt relief. Even though the seller didn't get that $45K in physical cash, being relieved of the obligation to pay it is considered a direct economic benefit. So the total amount realized is $105,000.
Ah, okay. 60 plus 45. Makes sense.
Exactly. Then the gain realized is simply this $105,000 amount realized minus their original $70,000 adjusted basis, which results in a gain of $35,000.
$35,000, not just the gain on the cash received.
Precisely. The significance here is profound. This example highlights how debt relief absolutely contributes to the amount realized. It's a common detail taxpayers overlook. Maybe they just focus on the cash, and that leads them to underestimate their realized gain, which, down the line, can result in a significant underpayment of tax, maybe penalties, interest. It's crucial for accurate tax planning to get this right. Avoid those nasty surprises.
Character is everything: capital versus ordinary assets and their tax impact.
Okay, here's where it gets, I think, really fascinating, because you mentioned how the gain is taxed. And not all gains and losses are treated equally by the taxman, right? It all boils down to something called the character of the gain or loss. Why does this matter so much? Is it purely about, like, what tax rate applies, or are there deeper implications for our financial strategy?
You've hit on a foundational truth of the tax code there. The character, whether a gain or loss is classified as capital or ordinary, is absolutely fundamental. Foundational. It dictates not just the tax rate applied to a gain, which is huge, but also the deductibility and the limitations of a loss. And this classification hinges entirely on how the asset was used by the taxpayer, how you used it. This isn't just theory. It's the difference between potentially paying a low preferential rate, maybe even 0%, versus your highest ordinary income rate, maybe 37% or more.
Wow, okay. That's a massive difference.
Huge. Failing to understand this distinction can lead to paying far more tax than necessary. Or, on the flip side, missing out on valuable deductions because you misclassified an asset's loss. Let's break down capital assets first. These are broadly defined by the tax code, often by saying what they aren't. But generally, think of assets held or used for investment purposes. The most common examples are things like stocks, bonds, mutual funds, maybe cryptocurrency like Bitcoin. Assets you acquire expecting them to appreciate or maybe generate income, not for immediate resale in a business.
Right, holding for growth.
Exactly. Or they can be held for personal use. This is important for individuals. This covers your personal car, your primary home, a vacation home, furniture, jewelry, artwork in your house. When you dispose of these types of assets, investment or personal use, the gains or losses are typically classified as capital gains or losses. The key takeaway for your planning: identify if the asset is truly for investment or personal use. That generally puts it in the capital asset bucket.
Okay, so that's capital assets. What's the alternative? Non-capital?
Correct. Non-capital assets. These are distinctly different because their primary purpose relates directly to a business activity, not personal use or passive investment. First, this category includes assets held for sale to customers in the ordinary course of business. The classic example is inventory.
Like cars for a car dealership or clothes for a clothing store.
Precisely. If you're a car dealership, the cars on your lot are inventory. They are non-capital assets because your business is selling them. Second, accounts receivable money owed to you by customers for goods sold or services rendered as part of your normal business. Those are also non-capital assets. They represent future ordinary income. And importantly, non-capital assets also encompass assets used in a taxpayer's trade or business. This is a big category. It includes real property like an office building, a factory, maybe rental property if it rises to the level of a trade or business, or personal property like machinery, equipment, computers, vehicles used directly in running your business.
So the delivery truck for the business, not my personal car.
Exactly. The disposition of these non-capital assets, inventory, receivables, business use assets, is generally taxed as ordinary income or loss. Now, there is a powerful exception here, worth mentioning briefly. Gains from certain trade or business assets under Section 1231 can sometimes get favorable capital gain treatment even though the asset itself isn't technically a capital asset. It's complex, a bit beyond today's scope, but good to know it exists. But the core point for you to remember is, if the asset is tied directly to your active business operations, its character is likely non-capital, meaning ordinary income or loss treatment, unless a specific rule like 1231 applies.
So what you're really saying is the same exact asset, let's say a piece of land, could be either capital or non-capital. It just depends entirely on its use and my intent. If I buy land to hold it for long-term appreciation, hoping it goes up in value, capital. But if I'm a developer buying that same land to subdivide and sell lots to customers, that's inventory, so it's non-capital. Or maybe business property.
You've got it exactly right. That highlights just how critical it is to understand your own intent and activity when you acquire and eventually dispose of an asset. It's not about the asset itself fundamentally, but how you use it that dictates its tax character. And that presents a massive planning opportunity or a potential pitfall if you get it wrong.
Definitely sounds like something to clarify, maybe with the tax advisor, right from the start when you buy something significant.
Decoding capital gains and losses for individual taxpayers, rules, rates, and relief.
Okay, now let's zoom right in on individuals, because you mentioned the rules here are particularly nuanced, and you also hinted they offer some of the most significant opportunities for tax planning, for saving real money. And it seems to start with something simple: how long you've held on to the asset, that holding period. It seems basic, but it's absolutely critically important, right? It separates the good tax news from the, well, potentially painful news.
Precisely. The holding period is the absolute linchpin for capital assets when it comes to individual taxation. It's the critical factor. It determines if a capital gain or loss is short-term or long-term, which then directly dictates the tax rate applied to your gains. And understanding this difference, leveraging it, can literally save you thousands, maybe tens of thousands of dollars. It's one of the most powerful levers in your personal tax strategy. Let's talk about the good news first. Long-term capital gains, LTCG. These are gains from capital assets you've held for more than 1 year. 1 year in the day, basically. The huge benefit here is the preferential tax rates they enjoy. 0%, 15%, or 20%.
0%.
Yes, absolutely 0% for some taxpayers. This is a huge, often transformative advantage compared to how your ordinary income, like wages, is taxed, which can hit rates up to 37%. To put this into perspective using the 2023 tax year figures, for example, a single filer with taxable income up to $44,625 pays 0% on their long-term capital gains.
Wow. So if you're in that bracket and sell stock held over a year, no federal capital gains tax.
Correct. It's a tremendous benefit, especially for lower and middle income individuals who are building wealth through long-term investing. Now, if a single filer's taxable income is between $44,626 and $492,300, the LTCG rate is 15%, still significantly lower than most ordinary rates, and only if their taxable income exceeds $492,300 does the LTCG rate hit the maximum 20%.
And these thresholds are different for married couples, heads of household.
Yes, they are. For married filing jointly in 2023, the 0% threshold went up to $89,250 taxable income, then 15% up to $553,850 and 20% above that. Head of household, 0% up to $59,750, 15% up to $523,050, 20%. Married filing separately mirrors the single filer thresholds for 0% and 15% mostly. These numbers adjust for inflation, but the tiered preferential structure remains. The key takeaway for your planning is knowing your overall taxable income bracket dictates this critical rate difference. Patience holding over a year becomes a highly profitable virtue.
Okay, so that's reward for patience. What about the other side? Short-term gains.
Right. Short-term capital gains, STCG. These are from capital assets held for 1 year or less. And the critical difference here is treatment. These gains are treated just like ordinary income. They're taxed at your regular income tax rates, which means they could be taxed at rates all the way up to 37%. You can see the stark contrast. Potentially 37% for short-term versus a max of 20% or even 0% or 15% for long-term.
Yeah, that's more than double the rate in some cases.
Exactly. This holding period distinction is why you often hear financial advisors stress holding investments for at least a year and a day before selling, if possible. It's not arbitrary. It's a direct route to tax optimization, literally cutting your potential tax bill on gains significantly.
And it's not just short versus long, is it? I think you mentioned earlier, even within long-term gains, there are some special categories, like collectibles. It feels like the tax code loves making things a little complicated.
It does seem that way sometimes. You're right. While most long-term gains get those attractive 0%, 15%, or 20% rates, certain assets fall into a special 28% rate group. It's almost like a different tier, taxed a bit higher than other long-term gains. This primarily applies to long-term gains on the sale of collectibles. Think works of art, rugs, antiques, metals like gold bullion, less it's specific ETFs maybe, gems, stamps, coin collections.
So if I sell an old coin collection I inherited and held for years, the gain is taxed higher than if I sold stock held for the same time.
Potentially, yes. The maximum tax rate on the gain from that collectible is capped at 28%. Even if you're in a lower overall bracket where other LTCG might be 15% or 20%, it doesn't get the most preferential treatment. Another really crucial item that can fall into this 28% potential rate category relates to qualified small business stock, QSBS. This is under Section 1202 of the tax code. Now, QSBS itself is incredibly beneficial. It refers to original issue stock from a U.S. C corporation, and you generally have to hold it for more than 5 years. Plus, the corporation must have met certain requirements, like having gross assets of $50 million or less both before and immediately after the stock was issued.
Okay, so specific criteria, but what's the benefit?
The benefit is massive. A taxpayer can potentially exclude a significant portion, sometimes 100% of the gain on the sale of QSBS. The exclusion amount is the greater of $10 million, or 10 times the taxpayer's original basis in that stock.
$10 million excluded, or 10 times basis.
Whichever is greater. It can lead to completely tax-free gains for many entrepreneurs and early-stage investors in qualifying small businesses. It's huge. Now, if there's any gain in excess of that substantial exclusion amount, that excess gain is then potentially taxed at a maximum rate of 28%. So QSBS offers this incredible upfront exclusion, and only the gain above that potentially hits the 28% rate. It's a prime example of the tax code incentivizing long-term investment in small, growing businesses. For your portfolio, if you hold stock in a private C Corp, investigating if it qualifies as QSBS is absolutely essential. It's often overlooked.
Okay, so that covers gains, different rates, special categories, lots of potential savings if you plan right. But what about the other side of the coin? What if the market doesn't cooperate and you end up with a net capital loss for the year? Is there any, silver lining there? Or is it just bad news, adding tax insult to financial injury? Can you use those losses to offset other income?
There is a silver lining, but it's, let's say, capped for individuals, which is a key point for managing losses and understanding their limitations for immediate tax benefit. While realizing losses is never the goal, understanding how to utilize them effectively can significantly mitigate the damage to your overall tax picture. This is where strategic tax loss harvesting often comes in. Let's dive into the net capital loss deduction and carryover rules for individuals. If you realize a net capital loss for the year, meaning your total capital losses exceed your total capital gains, you can deduct a portion of that loss against other types of income. You can deduct a maximum of $3,000 of that realized net capital loss from your other gross income. That could be ordinary income from your job, passive income, portfolio income like interest.
Just $3,000 per year, even if my net loss was, say, $50,000.
Correct. The limit is $3,000 per year, $1,500 if you're married filing separately. This $3,000 deduction directly reduces your overall taxable income for the year. Now, there's also an order to this. If you have both net short-term capital losses, STCL, and net long-term capital losses, LTCL, the net STCLs are deducted first against that $3,000 ordinary income limit.
Why short-term first?
It's generally more beneficial because STCLs would otherwise offset STCGs, which are taxed at higher ordinary rates anyway. By using the STCLs against the 30K ordinary income limit first, you're essentially getting the maximum tax rate benefit from those particular losses. Okay, so what happens if your net capital loss is more than $3,000, like your $50,000 example? Any excess net capital loss, the amount above the $3,000 you deducted, isn't lost. It can be carried forward to future tax years. And this carry forward period is indefinite. It lasts until the loss is completely used up.
Indefinite. So I could be using a large loss from this year for many years to come.
Absolutely. In future years, you use that carried forward loss first to offset any capital gains you might have in that year, following the netting rules we'll get to. If you still have some loss left after offsetting gains, you can then use up to another $3,000 against ordinary income in that future year. And critically, the loss maintains its character when carried forward. A short-term loss stays short-term. A long-term loss stays long-term. This indefinite carry forward is vital. It means even bad investment years can provide some long-term tax relief, offsetting future gains or providing that $3K annual deduction. And just quickly, there are a few specific types of losses that the tax code treats as capital losses, even if they don't seem like a typical stock sale. One is a personal non-business bad debt. If you lend money to, say, a friend for personal reasons, not business, and that debt becomes totally worthless, you genuinely can't collect it, it's treated as a short-term capital loss in the year it becomes worthless.
So not just an ordinary deduction.
Nope. Short-term capital loss subject to all the capital loss limitations. Similarly, worthless stock and securities. If a stock you own becomes completely worthless, its cost basis is treated as a capital loss, and the timing is specific. It's treated as if you sold it on the last day of the taxable year in which it became totally worthless. This determines the holding period, short or long term, and short sales of stock also result in capital gain or loss. The holding period is generally determined by how long you held the stock used to close the short sale, but the rules can get tricky depending on the specifics.
Okay, this is a lot of pieces. Short-term, long-term, that 28% group, the $3K limit, carryovers, these special losses. It feels like a complex matrix.
Yeah.
How do they all actually fit together on the tax return? You mentioned netting rules. There must be a specific process, right? Because just adding them all up clearly isn't going to work, and it sounds like the order of operations here is incredibly important for, well, minimizing your tax bill.
You are absolutely right. It can feel like a puzzle. But understanding the netting process is essential. It's not arbitrary. It's a system designed by the IRS to ensure gains and losses are combined correctly and, importantly, that losses offset gains in a way that generally provides the most tax benefit to you. It involves combining gains and losses within different tax rate groups first, and then offsetting the net results between groups in a very specific order. So, the netting process for individuals starts by categorizing all your capital gains and losses for the year, including any capital loss carry forwards from prior years. You first net them within each of these three distinct tax rate groups. Group 1, the short-term group, gains and losses from assets held 1 year or less. These are generally taxed at ordinary income rates. Group 2, the long-term 0.1520% group. This is for most typical long-term capital assets like stocks and bonds. Group 3, the long-term 28% group. This holds gains and losses from collectibles and any taxable portion of QSBS gains.
Okay, so net within each bucket first. Then what?
Then you look at the net result in each bucket. Scenario 1 is easy. If every group ends up with a net gain, or every group ends up with a net loss, then each net amount just keeps its character. Net gains are taxed at their group's rates, ordinary, 0.1520 or 28. If all groups have net losses, you take your $3,000 deduction against ordinary income, using STCL first, and the rest carries forward, maintaining its character. Simple enough. But scenario 2, mixed gains and losses. That's where the specific offsetting rules kick in. If some groups have net gains and others have net losses, the tax code dictates a specific order to minimize your tax burden. The core principle: use losses to offset gains, starting with the highest tax gains first.
Highest tax gains first. Okay, that makes sense for saving money. How does it work specifically?
Here's the order. If you have a net STCL, short-term capital loss, this loss is first used to offset any net gain in the 28% group. Collectibles, QSBS.
Let's start there.
Because those 28% gains are taxed higher than the 0.1520% gains, and the STCL itself relates to ordinary rates, so you're using an ordinary rate equivalent loss to wipe out the highest taxed capital gain first. It's the most efficient use. If any STCL remains after wiping out the 28% gain, then it's used to offset any net gain in the 0.1520% group. Now, what if you have a net LTCL, long-term capital loss, from the 0.1520% group? This loss is first used to offset any net gain in the 28% group, again using a lower tax loss to offset a higher taxed gain. If any 0.1520% loss remains, then it's used to offset any net STCG, short-term capital gain. And finally, if you have a net LTCL from the 28% group, this loss is first used to offset any net gain in the 0.1520%. If any 28% loss remains, then it's used to offset any net STCG.
Wow. Okay, that's a specific waterfall. Short-term losses hit high-rate long-term gains first. Long-term losses hit other long-term gains, then short-term gains.
Exactly. It seems complicated, but the goal is consistent. Match losses against gains in the order that results in the lowest possible tax overall for you. It's a system designed, in this instance, to be somewhat taxpayer favorable in how losses are applied.
This netting, it really does sound like a high-stakes puzzle. It's clear why people get confused or maybe just let their software handle it without understanding why. Can we walk through that example, Jessica Jones? I think seeing the numbers move through these steps would make it much clearer. Show us how a mix of everything short-term, long-term collectibles actually gets netted together.
Absolutely. This is the best way to really grasp it. Let's use example 2, Jessica Jones, a single taxpayer. It shows this interplay perfectly. So here are her transactions for the year. A stock. Held 6 months, short term. Sold for $10, basis 9K equals $1,000 STCG. B stock. Held 9 months, short term. Sold for 5K, basis 9K equals $4,000 STCL. C stock. Held 2 years, long term, 0.1520% group. Sold for 20K, basis 25K equals $5,000 LTCL. D stock. Held 5 years, long term, 0.1520% group. Sold for 30K, basis 18K, basis 7K was $1,000 LTCG.
Okay, quite a mix. Gain, loss, short, long, collectible gain. So step 1 is netting within the groups.
Correct. Step 1, calculate net within groups. Short-term group, plus $1,000 A stock and $94,000 B stock. Net these together, $1,000, $4,000, $3,000 nets SDCL. Long-term, $0.15,000 EC stock and plus $12,000 D stock. Net these, $12,000, $5,000, $7,000 net LTCCG. Long-term, 28% group, just the plus $1,000 from the sculpture. So $1,000 net LTCG in this group.
Okay, so after step 1, she has a $3,000 short-term loss, a $7,000 regular long-term gain, and a $1,000 collectible long-term gain. Now, the offsetting rules kick in.
Exactly. Step 2, apply offsetting rules, mixed gains losses. We have losses and gains, so we follow that specific order. We start with the net STCL of $3,000. Where does it go first? Against the highest rate group gain. So the $3,000 STCL first offsets the $1,000 LTCG from the 28% group, the sculpture.
Okay, so that $1,000 collectible gain is completely wiped out.
Wiped out, zeroed out. Now how much STCL is left? We started with $3,000, used $1,000. So we have $2,000 of STCL remaining.
Right, $2,000 left. Where does that go?
That remaining $2,000 net STCL is then offset against the next highest rate group with a gain, which is the $7,000 net LTCG from the 0.1520% group.
Okay, so the $7,000 gain is reduced by that remaining $2,000 loss.
Correct. Step 3, determine the result. After offsetting the remaining $2,000 STCL against the $7,000 net LTCG, 0.152%, we are left with $5,000 of net LTCG in the 0.152% group. $7,000 minus $2,000. And that's the final result for Jessica. She has a $5,000 net long-term capital gain that will be taxed at the preferential 0%, 15%, or 20% rate, depending on her total taxable income.
Wow. So that $3,000 short-term loss effectively eliminated the $1,000 higher tax collectible gain and reduced the lower tax long-term gain. That netting order really does optimize the outcome.
It absolutely does. This example perfectly shows how crucial those netting rules are. A $3,000 short-term loss, which on its own might only save tax at ordinary rates if used against STCG, was strategically used here to eliminate a 28% gain first, then reduce a 0.152% gain. It maximizes the tax benefit of the loss. Understanding this isn't just academic, it's a direct tool for tax savings.
Capital gains and losses for C corporations, a different animal.
So that's individuals. And wow, we've seen how incredibly complex but also strategically important the rules are for them. All those different rates, the netting, the carryovers, plenty of planning opportunities. But what about businesses, specifically C corporations? Do they get these same preferential treatments, or do they play by a completely different set of rules when it comes to capital gains and losses?
They play by a significantly different set of rules.
Yeah.
It's like a different animal altogether, and raises that question, why? Why so different? The answer really lies in their distinct legal and tax structure. C corporations are treated as separate taxable entities, unlike partnerships or S-corp where income flows through. The corporate tax rules are often designed to prevent certain types of tax sheltering between operating income and investment activities, leading to quite different treatment, especially for capital gains and losses. And spoiler alert, Usually not as favorable as for individuals.
Okay, so how do their net capital gains work then? No preferential rates.
Correct. For C corporations, net capital gains, regardless of holding period, short-term or long-term doesn't matter for the rate, are simply added to their ordinary income. They're then taxed at the regular corporate tax rate. There is no distinction in tax rate based on how long the corporation held the asset.
So no 0%, 15%, or 20% rates for corporations.
None. C corporations do not get the benefit of lower capital gains rates. If a corporation has a capital gain, whether from stock held a week or 10 years, it just gets lumped in with their operating profit, their interest income, everything else, and taxed at the flat corporate rate, currently 21% federally. This lack of preferential treatment definitely influences corporate investment strategy compared to individuals.
Okay, that's gains. What about losses? You said the $3,000 deduction was for individuals. What can corporations do with their net capital losses?
This is another major difference, and it's much more restrictive. Corporations cannot deduct any net capital losses from ordinary income, period.
Whoa, not even $3,000. Nothing.
Nothing against ordinary income. This is a stark contrast. Imagine a C Corp has a great year operationally, millions in ordinary income, but takes a huge hit on an investment portfolio, a massive net capital loss. That capital loss cannot immediately reduce their taxable operating income.
Ouch. So what good are the losses then?
They aren't useless, but their use is limited. Net capital losses for a C Corp are subject to carry-back and carry-forward rules. They can be carried back 3 years and carried forward 5 years.
3, 4, 5. Okay, to offset what?
Here's the crucial limitation. They can only be used to offset net capital gains in those other years within that carry-back, carry-forward window, 3 back, 5 forward. They can never be used to reduce ordinary business income. If the corporation doesn't have capital gains in the carry-back or carry-forward years, the capital loss might eventually expire unused after the 5-year carry-forward period.
Wow. So much less flexible. You really need capital gains to make use of capital losses as a C Corp.
Precisely. It makes managing the timing of gains and losses even more critical for corporations. So just to quickly summarize that key difference, like a past key takeaway, individual capital losses can deduct up to $3,000 a year from ordinary income, no carryback. Indefinite carry forward, maintains character. Corporate capital losses cannot deduct from ordinary income at all, carry back 3 years, carry forward 5 years, only offsets capital gains, treated as short-term when carried over. Very different worlds. Understanding which rules apply to your entity structure is fundamental.
The wrap-up non-deductible losses you need to avoid.
Okay, finally, let's talk about losses you just flat out can't deduct. Our sources call these the WRP losses. WRAP stands for Wash Sale, Related Party, and Personal Losses. It's like the IRS makes you wrap them up and throw them away for tax purposes. These sound like traps we need to know about, the kind that prevent you from getting those tax savings you might have been counting on. Why are these specific situations singled out? What's the logic, and what should we be watching out for?
That's a good way to think about it, traps to avoid. These specific situations are singled out because the IRS generally disallows a loss deduction in scenarios where they believe the loss isn't a true economic loss in the way they see it. Or perhaps where the transaction seems primarily designed to generate a tax benefit without a genuine change in the taxpayer's economic position. Understanding these rules, AB-RAP can prevent nasty surprises on your tax return and stop you from mistakenly claiming a deduction that'll just get kicked back, potentially with interest and penalties. They're anti-abuse rules, essentially. Let's start with the first one, wash sale losses. This is probably the most common trap for active investors, especially those trying to tax loss harvest selling losers to offset gains near year-end. A wash sale occurs when you sell a security, stock, bond, option for a loss, and then you repurchase substantially identical securities within a specific window, 30 days before the sale or are 30 days after the sale.
Okay, substantially identical, that means the same company stock. Or could it be trickier?
Usually it means the same stock or bond. It can get tricky with options or maybe different classes of stock from the same company, but generally selling Apple stock at a loss and buying Apple stock right back is the classic wash sale. And that window is key. 61 days total, 30 before the day of sale, 30 after. Note, this rule generally applies to investors, not dealers in securities acting in the ordinary course of business.
So if I trigger a wash sale, what happens? The loss is just gone.
The disallowed loss from the wash sale cannot be deducted in the year of the sale. So yes, you don't get the immediate tax benefit. But crucially, remember, this rule only applies to losses. If you sell a security for a gain and repurchase it within 30 days, the wash sale rules don't care. You pay the tax on the gain, get a new basis equal to your purchase price, no problem there.
Okay, so the loss is disallowed for now. But does it vanish forever?
No, and this is a critical point. While the loss deduction is disallowed immediately, it's not simply gone forever. Instead, it's essentially deferred. It gets accounted for through an adjustment to the basis of the repurchased security. The disallowed loss amount is added to the cost basis of the new, substantially identical shares you just bought.
Added to the basis, how does that help?
It helps later. By increasing the basis of the new shares, it reduces the taxable gain or increases the deductible loss when you eventually sell those new shares in a non-wash sale transaction. So you effectively recover the disallowed loss down the road. Think of it as pushing the loss forward in time, embedding it in the cost of the replacement shares. Also important, the date of acquisition, and thus the holding period, of the original shares tax onto the new shares. So if you sold shares you held long-term, triggered a wash sale, the new shares immediately have that same long-term holding period. That can be very beneficial.
Okay, let's walk through that example, Bob DePhilippis, because this deferral, the base adjustment, the holding period tacking, it sounds straightforward, but I bet seeing it with numbers helps. And that 30-day window applying before the sale, too.
Exactly. Let's use example 3, Bob. It's a classic wash sale scenario. The facts. Bob bought 100 shares of XYZ stock way back 15 years ago for $22,000, so long-term holding period. On April 1st of this year, he sells those 100 shares for $21,000. That's a $1,000 realized loss, 21K sale, 22K basis. Now, the key part. On April 25th, just 24 days later, well within the 30-day window, he buys another 100 shares of the same XYZ stock for $21,500.
Okay, sold at a loss, bought back the same stock within 30 days. That smells like a wash sale.
Textbook wash sale. Yes, It qualifies. So the consequence. That $1,000 realized loss on the April 1st sale is disallowed. Bob cannot deduct that $1,000 loss on his current year tax return.
Disallowed, but not gone forever.
Not gone forever. Now we adjust the basis of the new shares he bought on April 25th. His cost for the new shares was $21,500. We add the $1,000 disallowed wash sale loss to that cost. So his adjusted basis in the new 100 shares is $21,500 plus $1,000 with $22,500.
Ah, I see. So when he eventually sells these new shares, his gain will be $1,000 less or loss $1,000 more than it otherwise would have been. The loss is recovered then.
Precisely. And because of the holding period tacking rule, those new shares he bought on April 25th are immediately considered long-term, inheriting the 15-year holding period from the original shares he sold. So if he sells them next month, any gain would still be long-term. And just to reiterate that past key point, because it catches people, a wash sale occurs even if you buy the replacement shares 30 days before selling the original shares at a loss. Example, buy stock Jan 4 for $100. Buy more of the same stock March 5 for $40. Then sell the Jan 4 stock on March 15 for $41. That $59 loss, $100 basis $41 sale, is still a wash sale loss because you bought identical stock within 30 days before the loss sale. It prevents simply cycling shares to realize losses while maintaining your position.
Got it. Watch that 61-day window carefully. Okay, what's the R in RIBORIB? Related party losses.
Right, related party losses. The idea here is that sales between related parties are generally not considered arm's-length transactions. The IRS suspects these might lack true economic substance, maybe designed just to shift losses around for tax benefits without a real change in economic ownership or control. Related parties include immediate family, spouse, siblings, parents, grandparents, children, grandchildren, but not in-laws, aunts, uncles, cousins. It also includes an individual and a corporation or partnership they control, usually more than 50% ownership, or two corporations controlled by the same person, certain trust relationships. It's quite broad.
So I can't sell my losing stock to my sister just to claim the loss.
Generally, no. Any loss on such a sale between related parties is typically disallowed for the seller. There are some complex rules where the related buyer might get some benefit from the disallowed loss if they later sell the property at a gain, but the initial seller gets no deduction. It's about preventing artificial loss generation within a close economic unit.
Okay, disallowed. And the final one, P, personal losses. This sounds more straightforward.
It generally is. Personal losses. The rule is simple. No deduction is allowed for a loss on the disposal of a personal use asset. So, you sell your personal car for less than you paid. Tough luck, no deduction. Sell your old sofa, no deduction. Sell your primary home at a loss. Generally, no deduction, unless part was used for business.
Why not? Seems unfair if gains are taxed.
The rationale is these losses are considered part of the cost of living, personal consumption, not from an activity entered into for profit or investment. The decline in value is just seen as a personal expense. The IRS is generally interested in taxing gains on personal assets, but not allowing deductions for personal losses. The only significant exception mentioned in our sources is for casualty or theft losses on personal use property, but even then, only if they are attributable to a federally declared disaster and subject to other limitations as an itemized deduction. So, for everyday sales of personal items at a loss, forget about a tax deduction. It underscores again why knowing the character, business, investment, or personal is step one.
So what does this all mean for your financial life? We've covered a lot of ground today, from understanding the basic building blocks amount realized, adjusted basis, to distinguishing capital versus ordinary assets based on use, navigating those really intricate netting rules for individuals, seeing the starkly different rules for C corporations, and crucially, identifying and avoiding those pitfalls like wash sales, related party deals, and realizing you just can't deduct personal losses. There's clearly a lot to consider. But it feels like each piece of knowledge we've unpacked today is a potential tool for smarter tax planning and ultimately for maximizing your wealth.
Indeed. I always say knowledge is most valuable when it's understood and then applied. By truly grasping these rules, not just memorizing them, but understanding the why behind them, you're not just, decoding tax jargon. You're gaining the foresight to make genuinely informed decisions about your investments, about when and how you sell assets. And that can significantly impact your tax liability. It really transforms you from being just a passive taxpayer filling out forms to an active participant in your financial future. You can proactively manage your tax burden and, yes, keep more of what you earn. It's not just compliance. It's really about empowerment.
Yeah, I like that. This deep dive, we hope, has given you more than just isolated facts. We hope it's provided a framework, a way to look at your own assets, your own transactions, and think, wait a minute, how does this fit into the bigger picture of my tax strategy? Am I holding this long enough for those lower rates? Is this actually a capital asset given how I'm using it? Am I about to accidentally trigger a wash sale with this trade? Asking those questions, using this framework, seems like the key to unlocking those potential tax savings and avoiding some really costly mistakes.
And that naturally leads to an important question for you, the listener, to perhaps mull over. As you look at your own portfolio, your own assets, maybe something you're thinking of selling, or something you recently inherited. Which one of these rules we discussed today? Maybe it's the holding period distinction. Maybe it's those complex netting rules. Maybe it's the QSBS opportunity. Or even just avoiding a wash sale. Which one might be the most crucial, the most impactful for your next financial move? What stands out to why you right now as the biggest potential area for impact, or maybe the area you need to double check in your own situation?
Definitely something to think about. Food for thought, for sure. We'll catch you on the next deep dive.